Welcome to The Explainer. Today, we're tackling one of the most common questions out there for UK investors. What on earth happens when you lose money? And more importantly, can you actually turn that loss into a valuable asset? Let's find out.
So this is the big one, right? A lot of people ask this, hoping that if they've had a bad year, maybe they'll get a little cash rebate from the tax man. But the reality is a little different. And you know what? It's actually a lot more strategic.
So instead of getting money back in your pocket right now, HMRC lets you bank your losses. This creates a really powerful tool that you can legally use to slash your tax bill on any profits you make down the line.
All right, so let's get into the nuts and bolts of it. To really see how a loss can become an asset, we first have to get our heads around the basic rules that HMRC uses for all your investment profits and losses.
The main player here is capital gains tax. As it says, this is a tax on your profit, not the total amount you sold for. And the most important word here is net profit. HMRC is only interested in taxing you after you've subtracted all your losses from your gains.
And here's some good news. Everybody in the UK gets this tax-free allowance every single year. You can think of it like your own personal profit threshold. It means you can make up to $3,000 in net profit before you owe a single penny in capital gains tax.
Now, pay close attention here, because this is where a lot of people get tripped up. The order of operations is everything. HMRC's rules are super clear. You must deduct any losses from your gains in the same year before you even think about your tax-free allowance. So you can't use your allowance first to wipe out some profit. Here, that £4,000 loss brings the gain down to $6,000, and only then does the allowance get applied.
Okay, so before we actually run the numbers on our main example, we have to tackle a massive point of confusion: tax-free accounts. It is absolutely vital to understand that HMRC treats your trading completely differently depending on where it happens.
Honestly, the easiest way to think about this is that your trading exists in two totally separate worlds. In one corner, you've got your taxable accounts, like a general investment account or a CFD platform. And in the other, you've got these tax-free wrappers, like ISAs and SIPs. The rules for one world just do not apply to the other.
So here's the absolute crucial takeaway. Anything you do inside an ISA or a SIP is completely ring-fenced. Yeah, the profits are tax-free, which is fantastic, but it's a two-way street. It also means any losses you make inside that wrapper are totally useless for tax purposes. As far as HMRC is concerned, they're invisible. They just don't exist.
All right, let's put all of that together and see how it works in the real world. We're going to use a case study for the 2025-26 tax year to figure out a final position. Okay, here's the calculation. Now remember, we only look at the gains and losses from your taxable accounts. So we start with that £2,900 profit from stock trading. Then we subtract the full £5,600 loss from the CFD trading. And any profits or losses you made in your ISA or SIP, we completely ignore them.
And there we have it. That's a final number, a net loss of £2,700 for the year. This right here is the number that becomes your asset. This is the exact amount that you can now go and bank with HMRC to shield your future profits from tax.
So, you've got this £2,700 loss. That's great, but it's completely worthless unless you officially tell HMRC about it. I'm not kidding. This next step is absolutely non-negotiable. This is the only way to make it official. When you declare that loss on a tax return, you're creating a permanent record with HMRC. This is what it means to bank the loss. It makes it available for you to carry forward and use pretty much indefinitely until it's all gone.
And to do that, you've got to be aware of the deadlines. So for the tax year ending in April 2026, you'll have until October to register for self-assessment if it's your first time, and then until January 31st, 2027 to get your return filed online. You'll definitely want to pop those dates in your calendar.
To get this filed correctly and have proof of your numbers, you're going to need to gather a few key documents. Your brokers will give you reports that detail all your gains and losses. Make sure you get that annual statement from your CFD platform. And hey, even though a sale in your SIP might be tax-free, it's always a good idea to keep the paperwork for your own records.
This mind map really pulls it all together, doesn't it? You can see how that central idea of capital gains tax branches out to everything we've talked about, from the type of account you're using right down to the final calculation. But look how every single path leads to the exact same key action: officially reporting your losses to HMRC.
So, now that you know a loss isn't just a loss, that it's actually a potential tax shield for the future, how's that going to change the way you think about managing your portfolio? It's not just about chasing profits anymore.
It's about strategically managing your entire tax position. Thanks for joining us.